Well, VAT is chargeable on professional services supplied to pension schemes, and those include administration services, legal services, actuarial and consulting services. While an employer, provided it makes sufficient chargeable supplies, can recover the VAT on the services it receives, trustees, because they don't make chargeable supplies, can't recover the VAT on the invoices that they receive. Under current guidance, HMRC permits employers to recover VAT on services provided to trustees other than in respect of investment management services. This current guidance is due to expire at the end of this year due to the effect of the PPG case broadly. What happens is that invoices that are addressed to trustees can have something on them such as payable by the employer, and in which case the trustees can send the invoice to the employer and the employer can recover the VAT that's chargeable on that invoice as its own input tax, and then either ask the trustees to reimburse it or send the balance of the invoice back to the trustees to pay it, or pay it in full. But in whatever way they actually choose to use it, the employer itself is able to recover the VAT charged to the trustees. There's also something called the 70-30 rule, and that applies where a single invoice is issued to trustees that covers investment management services too, because as I've said, investment management services, the VAT isn't recoverable. That easement is also going to expire at the end of this year, but under that invoice, HMRC will notionally allow the invoice to be split 70% to investment management fees and 30% to administration charges. And the 30% that notionally applies to the administration charges, the VAT is recoverable on that. Well, that's a very good question. The EU VAT directive exempts services supplied to special investment funds from VAT. So we know what certain kinds, what certain special investment funds are. For example, authorised unit trusts and open-ended investment companies, OICs. Those are definitely special investment funds. There was a case in 2007, the JP Morgan Fleming Claverhouse case, that extended the definition to investment trust companies, which are closed-ended investment funds. There was then a discussion as to whether pension schemes themselves could be special investment funds, and if they were, the services supplied to pension schemes would be exempt supplies, and service providers wouldn't have to charge VAT on those services. The Wheels case, which was brought in 2012, actually partly sponsored by the NAPF, that concerned a common investment fund of a number of UK defined benefit pension schemes. The assets were commingled in this common investment fund. And they took a case to the ECJ and said, is this kind of arrangement a special investment fund? But the ECJ said in that case it wasn't sufficiently close to the other kinds of special investment funds to be one. And therefore, we thought from there onwards, a pension scheme wouldn't be a special investment fund. Well, this was an interesting case. It was decided in 2013 by the ECJ, and it's brought by a Danish company that provides services to defined contribution schemes in Denmark. And they said, do we have to charge VAT on the supplies that we provide to these defined contribution schemes if these defined contribution schemes are special investment funds? And the ECJ found that the characteristics of these Danish Danish defined contribution schemes were sufficiently close to special investment funds to be one. And therefore, it's now possible that DC occupational schemes in the UK will be special investment funds, and services supplied directly to them will therefore be exempt supplies. And that's discussed further in Brief 44 that was set out that was published in November last year. HMRC is trying to restrict the kind of services in respect of which will be fund management services and therefore exempt supplies. But there's still discussion going on about that guidance. Well, that's a completely separate line of argument as opposed to whether a pension scheme can be a special investment fund. And this is much more closely related to what happens in practice with defined benefit occupational pension schemes in the UK. So the PPG case concerned a Dutch company and a Dutch pension scheme. The Dutch company was legally required to provide the pension scheme, and it did, as a matter of choice, pay all the costs in relation to the pension scheme, including the investment management costs. And the company went to the ECJ and said, if we're paying the costs in relation to the pension scheme, can we recover the VAT on those costs that we're paying? And the ECJ said that provided the costs were a component of the goods and services provided by the company, then the VAT could be recovered. This is even though those costs included investment management costs, which are usually considered to be part of the activity of the fund and not the activity of the employer. It was referred back to the National Court to decide whether they actually were a component, but subject to that, the ECJ said that the VAT could be recovered by the employer if the employer paid it. HMRC has responded in a slightly confused fashion. We've had 2 lots of guidance, 3 if you count the tripartite agreement guidance this year. But the main guidance was delivered last year in November. And essentially, HMRC said that they acknowledged that employers, if they paid for the investment management fees, could potentially recover the VAT. However, in order for them to do that, the employer would need to enter into a tripartite agreement with the trustees. Well, we know what HMRC means by the tripartite agreement from its brief 8 that was published in March of this year, although it applies only to fund management costs. Essentially, it's quite onerous for employers and for trustees. HMRC is expecting the employer to join in the services agreement with the supplier and with the trustees. As I say, at the moment, only in relation to investment management agreements. The employer, under the terms of this agreement, must be responsible for the costs, and the service provider can pursue the employer for that. There's also rights for the employer to see the fund management reports, although the trustees, for some reason, can stipulate it's withheld, so we don't really know what that means. And the employer has the right to terminate the agreement. And as you can see, that's actually quite difficult in the context of trustees having the sole control of the investment power. And how it's going to work in relation to other service providers, such as legal advisors and the scheme actuary, is extremely difficult, and we haven't got guidance on that. In those cases, the duties are very much owed to the trustees, so it doesn't make sense. It's difficult conceptually for the employer to be a party to those agreements. And to be honest, we're still struggling with that. Well, a VAT group registration is an interesting option, I think. It does apply only in respect of corporate trustees. The main advantage is that if a corporate trustee can join its employer group registration, then the supplies that are made to the corporate trustees will be treated as supplies to the representative member. And therefore, if the representative member makes sufficient chargeable supplies, it can recover the VAT as a matter of course on the supplies that are made to the trustees. And there is no question then of tripartite agreements. There are some potential disadvantages or risks. One is that if the corporate trustee actually pays an awful lot in the amount of pension, then, which are exempt supplies, then it may prejudice the recovery of the group as a whole, but that can usually be arranged through divisions of the group, as I understand it, with the VAT inspector. Probably the main risk that people are aware of is the risk of liability to the trustees, because each member of a VAT group will be jointly and severally liable for the debts of the other group members if a VAT debt were to arise. However, HMRC has previously said in statements that that risk won't apply in relation to a pension trust. They wouldn't pursue a trustee for the debts of other VAT group members. And according to my VAT colleagues, that statement can be relied on until such time as it's withdrawn, of course. But for the time being, we don't think that there is a really major risk of liability to the trustees. Well, I do think it's really important at this stage that trustees are aware of the processes that they have, that are in place for paying the service provider fees that they have. They should be instructing their pensions managers to identify this. The trustees proactively could take it up with the employer. Alternatively, from an employer perspective, they should really be looking at that. If VAT recovery is important to them, and it needs to be looked at in the context of the group's tax strategy as a whole, then they should be aware of this guidance and they should be consulting with their advisors as to how they can take this forward.